Well. Good morning. This is Mr. Not Advice. It is Saturday, August 22nd. This is my weekend update. As always, this is for education and entertainment purposes only. Well, it's been a hell of a week this week, and just again, one of the most volatile weeks, one of the most headline-grabbing weeks that I've seen. This reminds me of some of the times, during 2000, during blow up of the great financial crisis, even during COVID. Just the frenetic amount of news from different and multiple sources, as well as different data points, both on a macro and global geopolitical basis. But with all of that happening, I remain convinced that better times are ahead, and our trade volume, over the last couple of weeks, I have tried to enter more trades. I have tried to, and my rules have kept me out of them, and that's obviously very frustrating. But as I've said repeatedly, I stick with the rules that have brought me and kept me in this game for the better part of almost 3.5 decades. And so I'll continue to do that, as frustrating and as boring as that might be. Okay, let's get started. Take a look at what's going on a macro and a global market overview this week. Obviously, we had a couple of stories this week that were leading, or a couple of themes that were leading the market or driving the market. Number one was Treasury's intervention into the Treasury market by announcing Operation Twist. It's effectively a soft QE where Treasury will start buying back 30%, could be even more, of the debt that it issues. In fact, in the first day that Scott Bessent announced it, within the very 24 hours, the long end of the curve, which is the very thing that Treasury is trying to drive down, it recovered. And as I've said before, I think there's a reason why long end of the curve, why 30-year rates continue to be pressured to the top side. The first reason would be global rates around the world have been rising, and that's unique to each country, but not unique, because bond traders are looking at the worsening uh, fiscal picture of each country as countries take on more and more debt. The U.S. is doing the same thing, with the U.S. Debt crossing $40 trillion for the first time in history. But I do think that the U.S., while it may not escape this unscathed, I do believe that we're in the best shape compared to all the other countries. Another crosswind that was going on in the market this week was the continued back and forth within Iran and the Iran conflict. Trump made the announcement that, or Bessent actually made the announcement that they're going to unleash the mother of all economic weapons against Iran. I saw an interesting note from I believe it was the foreign minister of Iran, said towards the end of the week that he surprisingly admitted that Iran is not exporting any oil and it has no access to its capital. So if the goal is to starve the populace, that's going on right now. They have hyperinflation, but with the people at the top, they're not missing any meals whatsoever. As a side note to that, though, we also had the Trump administration admitting that they're getting about 10 million barrels of oil out of the strait every night. And that's about half the amount of volume that was flowing through the strait pre-war. So it is not as if there's no oil coming out. The bottleneck remains, and I'll show you this chart in a bit, but the bottleneck remains in the refined products portion of the oil trade, taking oil and then refining it into gasoline or diesel or heating oil. That's where we're seeing inflation right now. So, but equities snapped a multi-week winning streak, with the SPX and the NASDAQ posting its first weekly loss since late July, and the Dow had its worst week since March. As this chart shows, long end yields tested multi-decade highs before the short-lived Treasury intervention, and that's also causing the dollar to dump for the fourth straight week. Gold and Bitcoin exploded higher as safe haven crypto short squeeze plays. And then Walmart provided an earnings, actually was more of a sales miss, that reminded everyone that the US consumer could be starting to crack, especially as gasoline tops $4. But looking at the 30-year Treasury yield, it pushed back above 5.3% at one point, its highest since 2007, and the 10-year traded at 4.7. It wasn't just the US, though. This is taking a look at the global bond yields. Japanese and German sovereign yields also hit multi-decade, multi-year highs, with Bloomberg's global bond aggregate index, this be the red, at 2007 highs. Message from bond traders is very simple but uncomfortable. Inflation might be moderating, but because of enormous fiscal deficits, record debt issuance, and AI related corporate borrowing and higher energy prices, they're all helping to keep 30-year rates elevated. Looking specifically at Japan, Japan's 10-year government bond yield pushed above 2.95%, which is its highest since the 1990s. And that was largely due in Japan to firmer inflation and manufacturing data, which is leading bond traders there to believe that the Bank of Japan could tighten policy even further. Why does that matter? Because Japan is one of the largest global sources for capital, for investments. So higher domestic Japanese government bond yields reduce the incentive for Japanese investors to go outside of Japan to buy US treasuries and European debt, which removes a historically important and large source of demand, just as governments outside of Japan are looking and needing to issue enormous amounts of paper. I wouldn't say that it's the perfect storm, but I'm starting to see some storm clouds that could portend and predict a much larger drawdown in the equities markets. I'm not quite there yet. I am keeping an eye on yields as well as global yields. As I've said over the last couple months, I'm keeping an eye on the crack spread as well as cost of refined products. But this is a chart of the refined product, and you can see that diesel is just soaring, much more so than crude. We also have gasoline and heating oil continuing to move up. So if we have higher crude prices, lower refining capacity, that raises inflation expectations. It therefore squeezes consumers because they have to pay more to power their cars and their trucks and heat their houses. It hurts transportation and travel margins. Put another way, it makes it a lot harder for any central bank, especially the US, to even think about or consider lowering interest rates. A final note, you can see here that the 10-year Treasury yield and the energy refined products basket are pretty much correlated. So bonds are focused on and will remain focused on refined products much more than oil. And that's important because if we have severely reduced refining capacity globally, with 35% of Russia's taken offline, and then we have the logjam in the Hormuz Strait, it's not something that's going to be fixed overnight. And the expectation that I would have is that rates are going to continue to pressure and move up, especially at the longer end of the curve. And that's going to require even more intervention by US Treasury as well as other global central banks. We know what that means. That means a influx of liquidity into the market that has a balance to it, because while interest rates moving up is bearish for stocks, generally speaking, uh, liquidity injections into the market is bullish for risk assets. So, and I think we started to see some of that play out with both gold and Bitcoin this week. Making it even worse, the average American is now paying gas prices that are over $4 a gallon, which I've always described gas at the pump as an immediate tax cut or tax break. And looking from the March lows when we were back down here below $3, this is pretty shocking And just imagine this is a 25% or 33% increase in what people are paying at the pump. That's probably why, partly why Walmart reported a reduction or a drop in sales that missed analyst forecasts. At the same time, Target and Home Depot came out with strong numbers, probably because there's a income segment to each of those franchises that is different. You would think, I would generally think that Walmart is servicing those lower to mid or lower to low income households, while Target's going to be mid to higher. Home Depot for home improvement. Certainly, if you don't have money to pay for groceries, you probably don't have money to do improvements to your house either. I also think some of this is related to, or Walmart directly is related to the tightening down of SNAP benefits as a result of Trump's policies to get rid of waste and fraud within the U.S. government. Okay, the S&P 500 and Nasdaq, as I said, suffered their first weekly decline since late July, and the Dow had its worst weekly performance in over, let's see, it was down 2 weeks in a row, and the worst weekly performance since March. It wasn't just the American markets; the global equities also followed, with the stocks 600 down roughly 1% for the week, and Japan's Nikkei off nearly 4% this week. Not surprising, with oil and refined products moving higher, that energy stocks soared this week. We were able to close our ConocoPhillips trade for plus 112%. But the energy sector was outpaced by the healthcare sector, which was really more driven by Moderna's massive price spike. So industrials joined tech as the worst performers this week. Mega caps were hit again this week as Broadcom reminded traders how much pain lurks in off balance sheet funding with the blowout of their CDS. Green here is a basket of broad AI stocks, and you can see it's starting to catch a bid downward at the same time to catch up with probably the continual drop in AI token costs. All the AI leaders were down significantly this week. This line here is the US S&P 500, excluding AI. So you can see that. And in fact, that's been a very good index to escape some of the volatility of the AI sector, is to invest in the S&P 500 XAI. As I said, Walmart had, I think, its largest drop, over 10% this week, which was the largest weekly drop since May of 2022. To repeat what I said earlier or expand upon it, it appears as though shoppers are becoming much more price sensitive, and companies with the right product mix or who happen to have affluent customers continue to perform. Normally, you would see surging U.S. yields would be rocket fuel for the dollar, and that did not happen this week. The dollar dumped almost 1% this week. This suggests that investors are interpreting the Treasury sell off as a fiscal credibility problem rather than simply a stronger growth or hawkish Fed story. According to Zero Hedge, this distinction matters. Rising yields plus a rising dollar generally signal monetary tightening, but rising yields plus a falling dollar instead can imply investors are demanding a larger risk premium for holding dollar denominated sovereign assets. If you think about it, it's sort of ridiculous. You've got investors selling dollar denominated products based upon the concern about the growing fiscal debt issue in the US. Well, that debt issue has existed for now well over a decade. And what's the difference between 38 million or 38 trillion and 40 trillion? A lot of the moves in the market on a shorter term basis, in fact, on any market or any stock or asset class, the shorter term ones are the initial reaction, the initial bot and algo and emotional human being reactions. And then what we wait for is to see if those develop in something of a more longer term trend. Remains to be seen if the dollar's weakness will continue, because there's so many moving parts. We're in an environment now where the market is being whiplashed by just multiple major crosswinds, whether it be the Middle East war with oil and refined products, AI disruption within the debt issuance market and the capital markets, rising interest rates globally throughout the major developed countries. These are push and pull, and at different times, you'll have one take the headline over the other. This week, it was interest rates. And that's why we saw assets such as gold and Bitcoin uh, do so well this week. Gold really spiked this week because it was almost the perfect mix for them. They had escalating Middle East tensions, a weaker dollar, stubborn inflation risks, and deteriorating confidence in sovereign bonds. A perfect mix for gold. And as you look at gold and you say on a mid or longer term basis, should I be investing in it? Well, those would be the questions you ask yourself. Do I think a weaker dollar, that the Middle East tensions will continue to escalate? Do I think that inflation will remain stubborn? Do I think that there will be deteriorating confidence in sovereign bonds? If you think those things and the sum of the data, then yes, you'd want to get long gold. For me as a trader, I'm looking purely for momentum and momentum breakouts as well as reversals. And so I have to be very careful and not get caught up in the longer macro stories or the themes that will take time to play out and resolve themselves. And while I have to keep those in mind because at various times in a trade, they would be either, what I call wind at my back or wind at my face. I'm very short term. If I enter a trade, I need to make money within 3 days. If I don't, I'm out of the trade. So it's very short term. If I make money in 3 days, then I stick with the trade, and then it becomes like a ConocoPhillips, right? Where I'm normally am used to having on a regular basis gains of over 100% in trades. But as I'll get to in a little bit here, the momentum side of the picture and just the sheer volatility of the market is what's made it very hard to trade. Unless you were asleep, you know, of course, that Bitcoin exploded more than 20%, which was its best week since 2024. Ethereum rallied even more, gaining almost 30% this week. Now, the big question is why? Well, we have a couple reasons why Bitcoin has exploded this week. And I've already gone over a couple of them, but to review, well, Treasury buyback plans, what does that do? Well, it raises hopes that there's going to be improved liquidity. The dollar weakened. Washington, while not getting the Clarity Act passed, they intensified their push for crypto friendly legislation. ETF inflows accelerated this week, and there was reportedly a brutal short squeeze that liquidated billions of dollars in bearish positions. That's right here. This was the biggest short cover liquidation event in crypto history. But looking at Bitcoin, it was very similar to the setup that we have in gold. If investors are truly worried about fiat currencies, fiscal dominance, and sovereign debt, scarce assets, assets that you can't produce more of at will, such as gold and digital gold, Bitcoin, they're going to start looking, and this week, even more interesting. We've got Jackson Hole this week, and I think it's this week, but it's going to be difficult for Fed Chair Kevin Warsh. On one hand, he has inflation indicators have moderated enough to argue against further immediate raising rates, but then you have oil surging. You then also have the consumer starting to show cracks, as we saw with Walmart's sales miss. But financial conditions remain pretty loose throughout our economy, meaning there's easy access to debt and capital. Treasury yields are soaring, though, even with another Fed hike and despite Bessent's buyback promises. I'm sorry, Treasury yields were soaring without another Fed hike and despite Bessent's and Treasury's buyback promises. So we have a three-way collision, as Zero Hedge puts it, between growth risk, inflation risk, and fiscal risk. But this week looked a lot less like the conventional risk off that we see in the early stages of regime change. This looks more like a response to higher oil means higher inflation risk to higher long end yields, which leads to lower equity multiples. So this might be more of not a complete regime change, but more of an opportunistic trade. It becomes a regime change if these conditions worsen or take a lot longer time. If we drill in a little bit deeper in terms of the U.S. markets, hedge funds this week had their second largest week of global equity selling in the past year. Beneath that headline, the positioning data is pretty much communicating that hedge fund investors are getting cautious. According to Morgan Stanley, this was the second largest week of supply in the last 12 months. And the more notable was not that the amount of selling, but it was the broadness of the selling. They were the very same themes that drove the June and July unwind, including AI tech, global memory, semi-cap, large cap banks, and metals and miners all were sold this week. Fundamental long short gross leverage is at a third percentile, and net leverage is at a fourth percentile over a 1 year look back. The net decline was the largest weekly net decline in 5 months. So hedge funds, long short hedge funds, macro hedge funds, right, are deleveraging once again. The fundamental hedge fund long short ratio decreased 3.4% to 1.61%. Again, another sign of US hedge funds getting deleveraged and reducing risk. According to Goldman Sachs Prime Desk, Infotech was by far the most dollar net sold global sector this week, as the sector saw the largest percent degrossing in over 2 years. NVIDIA traded this week for 6 straight days red, which is its longest losing streak in 4 years. And it's not only in the public equities world that there is caution. We're seeing that M&A activity across the world are continuing to slow. Globally now down 5% year over year for Q3, with the U.S. being the laggard with M&A activity down 14%. One of the most interesting things is that even to have all this caution, valuations they're not very extreme. I was making this comment to a member the other day that we've seen, price to earnings ratios compress while we've seen earnings go up and earnings expectations increase. That's not normally how it works, right? You usually have increasing PEs when you have increasing earnings. The NASDAQ 100 right now is trading at 22.8 forward earnings, which is actually below its 10-year average at 24.8. So it's not valuations right now that are scaring investors or causing them to tighten up in hedge fund world. So you have to ask yourself, what is it that's scaring investors? One possible reason, and something that I've been dealing with this entire year, is just the insane amount of volatility that AI creates. Momentum volatility, okay, right here, it remains at the highest level since COVID, while S&P volatility remains subdued. This makes it a very, very difficult market to trade. And to drive this point home even more, this is momentum sell-offs. These are 5% or worse 1 day sell-offs. And we have had more of those this year than the previous 5 years combined. I guess the statement would be the AI trade, while it's working, it's being able to hold on to those assets is becoming increasingly more and more difficult. I think that this is a temporary function. Temporary meaning it could go on for more months, 9 months, 12 months, but I believe, as I made the case for last week, that we've already crossed the Rubicon with the slowdown in the acceleration of the rate of growth within the AI sector, specifically in the debt issuance variable of the AI sector. So, do I think that the market's going to crash? No, I don't think that. Nor do I think that the 30-year yield is going to continue to rise unabated. The market moves from theme to theme, right? Whether those themes are, 1 point AI or chip makers or hyperscalers or large language models, and then it switches to oil, the Middle East, defense stocks. This week, we had a switch temporarily into healthcare because of Moderna. And the market is always looking for a theme. You know, professional investors are very similar to retail investors in that they buy the story, they do straight line extrapolation on price directionally, they get caught up in the hype and the excitement. They also get frustrated. Uh, there's really, having been a professional for 30 years, the same traps that many investors fall into are the same exact traps that many professionals fall into. And when I see that there's this rotation, quick rotations from theme to theme, it just reinforces for me my experience that as I've always said, I want to make the most amount of money in the least amount of time with the least amount of risk and least amount of effort. Well, especially in this very volatile market, you really only have two choices. You either are going to buy something and deal with the volatility and all the psychological and emotional pain that that's going to create to hold that particular asset long term, or you're going to be somebody like me that swing trades on very short term time frames. Risk remains high. Now, it doesn't remain high to the extent that the market's going to crash, but it does remain incredibly high relative to very quick reversals of not only the market, but also of whatever story is out there in the market. Do I think that Bitcoin will continue up? Yes, I do. I'd love to get a pullback because I'm not somebody who chases. But yes, I do. Do I think it's anything more than a dead cat bounce? That remains to be seen. I'm not a fan of Bitcoin because I think ultimately Bitcoin is an inverse pyramid scheme because it doesn't produce anything. At least Ethereum is being used for banking, but to have banking built upon it and transactions built upon it, it's blockchain. But Bitcoin produces nothing. It is valued by its scarcity. Okay. Now, the one good thing that I did see this week for Bitcoin investors is there was a drive into Bitcoin as a safety hedge against inflation. Now, I also believe, well, I can't prove it, we'll find out later, down the road, but I do believe this little move up or this big move up was triggered. It was caused. Uh, Purposely. Whether that comes out to be Citadel or Jane Street, we don't know, and we may never know. But when I see these huge, fast moves like this, it's it's not as if Bitcoin demand all of a sudden exploded because of rising Treasury yields. No, Treasury yields have been rising. So why this week? Probably a combination of multiple data points coalescing right around the same time. But there's always a spark, right? And I do think that Bitcoin and Ethereum have room to go. Do I think that we've seen the bottom in Bitcoin? I am not a Bitcoin trader. I do think that we are going to see lower prices in both Bitcoin and Ethereum within the next 60 to 90 days. But, the point I want to leave you with is that professional investors fight against the same struggles that the average investor does. They just have better training, better guardrails, better everything to help control those uh, animal spirits, so to speak. But they get caught up in the emotion, they get caught up in the story, they get caught up in the whiplash. The one thing that I do sort of smile about is they're trading in this market too, and this is a very difficult market to trade in right now. And as it is with everything, this too shall come to pass. And while we are in this type of environment, my number one rule of trading really stands out, which is to protect capital. If the environment isn't there for you to be able to make money as you have in the past and be able to take on risks with a high probability of success, then you probably shouldn't be trading. It's so easy to get caught up in the story and the emotion and to flood into Bitcoin right now or flood into, and I'll, as I said, I fully intend to get long Ethereum. I fully intend to get long silver. Okay. Because I don't think the cocktail of bad news that's forcing these assets to go up is going to be resolved anytime soon. I really don't. Um, in fact, I would go as far as to say that the Kevin Warsh and Scott Bessent are right now not on extreme opposites, but they're not on the same page. They're definitely on different pages because Warsh wants to lower rates. He doesn't want to raise rates. And yet Bessent's action, Treasury's action this week clearly wasn't enough to, from a market standpoint, to help tamp down rising interest rates on the 20 and 30 year. Well, then on top of that, you have these cross currents of rising inflation due to the Middle East, and you have the dollar value dropping. It is it's always incredible to me, all the different moving parts and the interrelationships of all these different asset classes and stories and themes within the financial markets. So where does that leave a trader like me? I remain cautious. I think the overall market, which is a broad theme or a broader variable, remains very difficult to trade. As I've shown you, just looking at this chart, the momentum. This is volatility. As I said, we've suffered more 5% one-day sell-offs this year than in the previous 5 years combined. Look, bots and algos take that into consideration also, and if they don't tighten up, what they do is they broaden their risk metric to adjust for the adjusted new volatility picture, the current volatility picture in the market, which almost becomes like this self-reinforcing loop. I think that there's going to be tremendous political pressure for Trump to get gas rates down. I don't know how the Iran conflict finally resolves itself, as it seems both parties are just willing to wait each other out. But Iran's admission this week that they're not exporting any oil, and they've losing access to their capital. That can only go on for so long. So the one thing I am confident of is change. And so every week provides a new opportunity. I'll continue to manage the risk um, and manage my trades accordingly. And right now, I have, like I said, I try to get into, I think maybe 14 or 15 trades last week. I was able to get into one or two, right? Carnival Cruise Line short, got into a wheat trade to the long side. Absent of those trades, I continue to follow my rules, and those rules are what has been keeping me out of the market. Let's take a look at some individual charts. I did post on Twitter about a reversal in EOSE. I want to take a look at that. But let's go ahead and start taking a look at these now. Before we move on to some individual stock charts, I do want to return back to interest rates. A lot of the hand wringing that we're seeing from the interest rate crowd in the bond market, part of it is due to the fact that we have lots of participants that were not in the market in the early 2000s. That's number one. And because what happened? Well, we had a artificially suppressed interest rate policy due to quantitative easing, and that helped drive mortgage rates down and rates across the board down. What did that do? Well, that created this perception and environment that real rates should stay artificially low, when in fact, as this shows, we have actually just returned back to what has been an average from 97 to 2026, an average 30-year treasury yield, which is actually higher at 6%. I remember back in the late 70s, early 80s, when triple or A credit, my parents were paying 12 and 13% for a 30-year fixed mortgage. Now, that was, higher inflation, but we went from, 12 and 13% down to 1.5% rates. This is a return to a more normal interest rate policy and interest rate level, but it feels a lot worse. When you hear traders talk about, well, the amount of debt that we're paying is unsustainable, as a data point, the federal interest outlays in 1991 accounted for about 3.16% of GDP. 2025, 3.15% of GDP. The real damage is in the destruction in the value of the dollar. So, because in 1990, Every dollar of nominal GDP growth required about 23 cents. I'm sorry, in 1960. Today, it requires about $1.52 of new federal debt. So the debasement of the dollar is really where the focus should be, not on just merely interest rates. And this, of course, is illustrating what I just spoke to you about, which is the interest burden versus GDP of the U.S. economy. This is not now. Now you'll see analysts point out the sheer huge dollar amount. Okay, with 2.8 billion of interest payments every day by the federal government. And that is a large number, especially when you add it up. But when you put it in the context of it, what is it relative to GDP? It's no, we're not even, well, I mean, we're almost at the 91 level, but look at this. You know, you had a period of significantly, the government being able to refinance debt at significantly low rates. And now we're returning to normal. But because we've had such a long period of artificially low rates, it feels as though on this recent rise in rates, it feels like that it's the wheels are coming off. That's really not what's happening. And in fact, if we look at the historical rates, okay, from 2023 to 2026, and these are the actual changes. If you say, okay, well, I've got the 30-year bond moving up plus 117 basis points. Okay. I've got short term rates coming down 168 basis points. But long term inflation, 30-year inflation, okay, is only at 20 basis points. So the forward measure the Fed actually watches is actually going the wrong way for those who have an inflation thesis. So if we have real rates of the 30-year bond moving up 117 basis points, okay, in the past 3 years. And we have the change in the 30-year expected inflation up only 20 basis points. Well, where's the other 97 basis points? If inflation expectations only moved up 20 basis points, then where is the other 97 basis points coming from, which was the increase in the 30-year bond during the same period? Some of that's a return to normal, but some of that's also has to do with what? It's the higher premium, right? Yield being demanded by bond investors as compensation for longer duration. Furthermore, that's not actually inflationary. That's actually disinflationary because investors are demanding more compensation to hold, okay, longer term bonds right here in the face of relentless debt issuance. They are not demanding higher rates because they expect high future inflation. I just wanted to make that point to put into perspective that this is really not, and I've been one that's been saying this, I've been pretty set that the Fed's not going to raise rates, that I believe rates are going to be coming down. And I think, as I put out last week, I think people are focusing on the headline numbers and what makes the easiest sense, the quickest, the 1.3 billion a day of interest payments, and multiplying that out by 365 days and coming up with this ginormous number, and simply ignoring the fact that relative to the GDP, it hasn't changed. So, and furthermore, that they're looking at the 30-year bond and saying, oh my gosh, look how much it's risen. That must be an expectation of inflation, longer term inflation rising, when in fact it's not. What it's they're demanding more money, more yield on investors because the U.S. government and global economies continue to print so much debt. So why don't we take a look at some individual stock charts? Okay, let's look at some individual charts. I posted a chart on Friday based on this on EOSE. This is a confirmed reversal, and some of the differences between this reversal and this reversal are, first of all, this trade I couldn't take because of earnings were so close, but One thing that you'll notice about the difference in the candles, this is much more closer to a hammer candle, which means very simply that there was a push by the market trying to push it even lower. It failed, is interpreted by me as a more bullish reversal type candle. And in fact, we had that confirmed on Friday. Yes. So Thursday's candle, Friday's close. This is a classic textbook reversal signal. Why am I not taking it? Well, the purple line is the Russell 2000. And in lieu of news, individual news by the company, price of EOSE has been largely correlated with the overall Russell 2000. And the Russell 2000 was very volatile this week relative to what? The 30-year and 20-year yields. So as we saw pressure in those yields moving up, we saw the Russell sell off. Remember, small cap stocks get hit even worse when there are interest rate moves or the focus of the market is on interest rates rising because small cap stocks do not have balance sheets that can withstand short-term spikes in interest rates because they need to constantly be tapping the credit markets to maintain their operations. And that's the broader picture and definition of small cap stocks. And that relationship is about as close to being written in stone as you can get. So what happens? In an environment where a larger macro story of rising interest rates is what's taking the headline, then the bots and algos within the Russell 2000 or that govern the Russell 2000, there's going to be selling within those components that drives the Russell 2000 down. It doesn't mean that all the individual stocks of the small cap market all of a sudden are doing worse. It has more to do with the mechanical flow of dollars in and out of asset classes. Remember, portfolio managers, while there's this misbelief that their goal is all for absolute return, they have so many other hoops that they have to jump through. They've got to balance according to volatility. So, volatility S&P 500 versus the Russell. They've got to balance according to Greeks, okay, which are going to be different for high volatility stocks versus low volatility. Well, historically, small cap stocks have been more volatile than large cap stocks. And so when you see these types of moves, especially when interest rates become the headline, okay, it's very difficult for a small cap company to uh, be able to break out of the overall trend of the asset class, capitalization asset class that it's in. So the answer to my question, which was, am I going to take this reversal? No, I'm not, because there's an overriding theme that adds a level of risk that I have no visibility on, which is interest rates. Meaning, I don't know what the headlines are going to be next week or the following week. I don't know what the bond market, which is massive, even though their perception of interest rates and that they're exploding higher relative to history is completely wrong. Okay. And I just went over that. It's and this reinforces what I said earlier also, that professional investors are just as smart or lack thereof as retail investors. They're focusing on the numbers that are pushed in front of them, and oftentimes they're not the right numbers. And it's not the right way to look at the data because it's giving them a false positive that happens to support the overall thesis for the market at that moment. It's very difficult to stand out in the crowd as an investor. It's very difficult to uh, take a counter argument and then put up with the mental and psychological pressure of not being in a herd. So I'm not going to take this because, very simply, it is a reversal. It's a higher low, swing low. I like that. It was on decent volume. It's almost a perfect angle of the downtrend. And my expectation would be, as I teach, that any reversal, the reversal of it price will be equal to the trend that led into the reversal. So I think this could come all the way back up to 446. But again, with the interest rates being the driving one of the driving functions and variables of the market currently, if we get more, let's call it bearishness about interest rates, meaning interest rates going up, then that's going to hurt small caps again. And I just can't trade where one of the main variables or the main variable is not the company itself, but it is this outlier variable that is not entirely macro based, but much more perception based. So I'll pass on the EOSE trade. In fact, if you drill out, I just was doing this. If you drill out, there was a period of time, okay, where EOSE had absolutely disjointed itself from the Russell 2000 right here. It completely became disjointed to the Russell 2000. Now, if the Russell 2000, if we can get through this interest rate problem, and if the Russell 2000 sort of gets pushed to the back pages of the investment community's focus, that at that time I'll be much more inclined to take at looking at long. So my area of where I'd like to get long remains 446 to 472. Looking at PCT, we're in a downtrend. You can see this support level here at 659, which has now been tested 3 times. If we break this level, I will short this stock. Why? Because it's in a downtrend, because I don't expect or I don't know of any possible news that's going to be coming out of PCT. And that's a difference between EOSC and PCT. EOSC, there's very stated benchmarks, right? There's very well-known events that are going to be happening and reported upon. With PCT, I know of none. I mean, they might get a contract out of the blue. They might get another favorable state ruling. I don't know that. So when in doubt, or when a stock goes quiet, especially small caps, they tend to drift downwards. Okay. They just merely tend to drift downwards. A vacuum creates weakness in price. And so has nothing to do with the long-term view of PCT. Actually, PCT's, as you know, has been on my buy list. I tried to get long here, and only my rules prevented me on the very next day, my entry day. Only my rules kept me out of that trade. Thank God. Yes. And so on a short-term basis, yeah. How far do I think that could go? Well, shoot, I think we could come all the way down to this level, which would be the low would be 575. So from 659 to 575. So, for those of you that are long-term holders, not a big deal. It's either going to break out of this mess to the downside, or we're going to go right back up and keep testing this top side. On a clean break of this on the daily, I will be going short. We are in CCL. CCL, we got in on this break. Okay. Right here. This was our trigger. This was our entry, right? We are up 12% in one day, and then this retracement happened. But if you look at this candle, what did we get? Almost a perfect 50% retrace, right? So what does that tell me? Well, unless this does a much stronger move to the top side, this trend will continue. Stocks in trend, when on a very short-term basis go out of trend, the stocks want to stay in trend. And so much of it has to do with mechanical selling by algos and bots. But the other thing that CCL has, Carnival Cruise Lines, or as I call it, Snap Cruise Lines, the other thing that it has going against it is rising fuel costs, right? As I said earlier, the travel and transportation industry is continuing to not only be concerned, but be hit by fuel costs. It's not like a boat pulls up at the port and then buys their fuel. They buy it ahead of time. Right now, I think we finished the day up only maybe 2%. So day 3 is Monday. If Monday we don't get at least a 20% scale on the call option, we'll be flat on Tuesday. We remain long wheat. Okay. Wheat is in a longer term uptrend. If you take a look here, and we are within shouting distance of 2608. Could it reverse here? Yes. Has it reversed here before? Yes. Looking at crop reports that came out, and the fact that the U.S., the middle of the country where the farming occurs, the second crop planting,
I believe, was 40% below normal or below average. We're going to see continued inflation, and we saw that come out of Walmart. That where did they see inflation? In food, and that was causing consumers to pull back on spending. The one that is causing me a little bit of concern is the US dollar, because when I saw rates explode on Friday, I fully expected the US dollar to move up, and it didn't. And so, if that continues to occur, where global investors on a very short term basis decide that they'd much rather buy assets that are not priced in the dollar, such as gold or Bitcoin, then the US dollar is going to get weaker. Okay. But again, I'm out to January on those. Looking at silver, I believe silver is very near my breakout level here. Okay. 71.67. I just read a report by, I think it was Goldman, that puts silver at $90 by the end of this year, and is actually a very conservative price call. I'm not touching right now gold. I'm looking at gold miners currently, such as the junior miners, because they usually move after the gold move has done. And plus, my rules tell me I can't chase. And chasing for me means I wasn't able to get in where there was previous consolidation and a break. I'm merely chasing price up, and I don't do that. Ethereum, we look at the price of Ethereum. Where would I look to get long? Well, we did not close above this high into this gap. So that's what I'm waiting for. I need to see a close into the gap, because then it becomes, to me, at least I have a technical reason and basis to take the trade. Why? Because I need to follow my own rules. Where would I look to get long Bitcoin? Well, it'd be closer to 83,000 right here, the high. Okay. Are we going to get there? I have no idea. Right. I don't, this is not normal, right? A 20% increase is not normal in the price of Bitcoin within a span of 3 days. Yes, I think it was triggered and engineered by somebody. I'm happy to miss a trade if it means that I'm obeying my rules. I'm not going to chase a trade just because everyone else and the press is talking about it and all that garbage. I just won't do it. And that's what's kept me at the table. I want to close today, and I didn't have a lot of charts to go off of, but I want to close today by sharing this. All you did as a trader is respect your stops and scale for profits as price goes up, which completely removes the possibility of round tripping stocks up and down and doing nothing. If that's all you did, okay, uh, I believe within 3 years you would consistently make money. Now, you may not make a lot of money, but think about it. When you respect a stop, you're protecting capital, but that's creating positive alpha because it's avoiding negative alpha, negative return. Yes. And investment community is so much focused on the gains, while at the same time they're completely ignorant, willfully ignorant of the fact that avoiding large losses, preventing large losses, and keeping losses small, in addition to having a high probability success rate and all that good stuff. But keeping those losses small is as important, if not more important, okay, to long term success in investing, uh, as finding the next unicorn or finding the next, latest and greatest stock. And scaling for profits is the same thing. It's why it's so difficult for people to do, right? As stocks go up, people get excited. It's going to keep going up. They start looking at the chart and start planning their retirement and straight line extrapolating. So they refuse to sell. And then when it turns and comes back down, oh, it will bounce again back up. And before they know it, they're right back down at where their purchase price was or worse. But at the very least, all those gains have disappeared, and they didn't participate in them. Investing is so much about hitting singles, doubles, and triples, and yet investors focus on home runs. Home runs happen, and they're going to happen more if you obey the rules. You only swing at the pitches that you know you should be swinging at. You stay off those pitches that are out of your zone. Okay. And then when you do strike out, you don't make it worse by getting up to the plate, getting angry, and doing the same damn thing emotionally that cause you to strike out perhaps the first time. My non-advice to you, if you're listening, is you got to learn to respect stops. You got to learn to scale for profits. And you have to learn how to take in all the noise, even when it's party on noise, and distill it down to how does it affect your trading plan. And if you don't have a trading plan and you're in the market, then I hate to say this, you deserve to lose money. To think a stock is going up because you like it, then you deserve to lose money, quite frankly.
Well, that wraps up my weekend update this week. I hope you have a great weekend, end of the summer weekend. I think we got 2 weeks left before late Labor Day. And good news, some exciting news for me. My long-awaited or long-toiled-on book will finally be released here in the next couple of weeks. It's in the editor's hands. As he said, this has been a brain dump of the last 30 some years of experience. So those who decide to purchase it will be able to decide if there's anything left in my brain or was in my brain. But welcome you again to join the Discord. It's free. We have dedicated rooms for crypto, NFX, INV, TCT, EOSE, and it's just a great group of investors. Those who are experienced, those who want to learn, which is all of us, helping one another. So I do welcome you to that. So hope you have a great weekend, and I will talk with you all next week. Thank you very much.
Some good friends screaming, let me out. People on streets turned away.